Hello, everyone, and welcome to the season 5 of the edX speaker series, The Future of Finance. I'm Emmanuel Josenko. I'm the executive director of the Graduate Finance program here at edX. And it's my pleasure to kick off this new season with Professor Brian Kelly. So, well, I don't have to present to Brian. That means I think that everybody knows Brian. Brian is professor of finance at Yale School of Management. He's the head of machine learning at Acquire Capital. He's been very, very prolific. His research spans asset pricing, financial econometrics, and the topic of today is a super interesting virtue of complexity. So I think that today Brian will do a focus on how complexity or highly parameterized factor models could be of interest for cross-sectional pricing. I want also like to thank my colleagues, Professor Ramanupal, who is also well known. I don't have to introduce himself. He's our expert on asset pricing too. And I'm very pleased to have today one of our bright students from the MSc in Financial Engineering, Thomas Rennes. So without further ado, Brian, the floor is yours.
Great, thank you very much. It's a pleasure and an honor. Hopefully my slides are visible now.
Yep.
So I'm going to be presenting on this topic of virtue of complexity, which is a sequence of papers that I've written with my longtime co-author, Semyon Malamud, as well as with various other co-authors, a combination of our students at Yale and EPFL. Eventually, I want to work towards discussion of the role of complexity in asset pricing models, in particular in cross-sectional asset pricing models. But to get there, I want to spend a little time first talking about the precursor paper, The Virtue of Complexity and Return Prediction, to give us a little bit of a foundation before moving on to the more complicated environment. But I want to start off with a bit of an overview of the role of complexity in financial modeling. So I've put a quote on the slide here that's rooted in this idea of a principle of parsimony, which is an old idea in statistics. It goes at least back to Tukey. And I put this quote up because this is one of the textbooks that I was trained on when I learned time series econometrics, a famous textbook by George Box, a very well-known statistician. And in the first chapter of this textbook, it's called something like Rules for Effective Model Building. There are 4 rules. And rule number 1 in chapter number 1 is this: it is important in practice that we employ the smallest possible number of parameters for adequate representations. The reason why I start here is because I want us to appreciate that we were in some sense taught a bias in favor of small models. And this bias clashes to a large extent with the world of modern statistics and the success of modern prediction models in lots of different applications. Of course, many of us will be familiar with the role of large language models. You take a model like GPT, which has over 1 trillion parameters in it. Even in return prediction analyses, right, asset pricing modeling, take, for example, some of my earlier work with Dacheng Xu, where we studied neural network models for the cross-sectional returns. And in those models, they're puny by sort of Silicon Valley standards, but they still have 30,000 or so parameters in them. These are models that have worked pretty extraordinarily out of sample compared to a lot of the simpler models that we have at our disposal. I like to start here because if you look at what's happened in machine learning from the perspective of a Box-Jenkins econometrician, that seems ludicrous, right? It seems that these models with 30,000 parameters, let alone 1 trillion parameters, are going to be massively overfit. And if we think they're massively overfit, then they're likely to behave terribly when we go out of sample. But this is, of course, not the case. We use every day extremely heavily parameterized models, whether we're using voice recognition software on our phone, whether we're using ChatGPT to look up the answer to any question that we might be interested in. We are used to using models that are demonstrating on a day-to-day basis their success out of sample, right? So I just want us to be cognizant of the fact that there is an enormous expansion of models that are massively, massively heavily parameterized, so heavily parameterized that they very easily fit the training data. yet they perform exceedingly well out of sample. And it's often the case, in fact, that if I have two models that both exactly fit the training data, it's not uncommon to see the larger of those two models work better out of sample. Right? And this is not just something that's happening in image recognition or textual analysis. It happens in finance too. Right? So a lot of the motivation for this line of research is to recognize that, well, the work that I and other people in our field have done have documented, in my view, unambiguously clear empirical gains to using machine learning models in finance applications. Right? These are not small gains. The typical gains from using a machine learning formulation to, say, represent an SDF or represent a return prediction model are oftentimes more than a few percent. They might be a couple times better than comparable simple models. Right? Now, I think one of the difficulties in working in this literature is that we don't have as much theoretical understanding of the properties of these heavily parameterized models. Right? And without a good theoretical understanding, it's natural for there to be a lot of skepticism about the reliability of models like this. Right? So you can think about this as really being the genesis of this research agenda. What I'm hoping to do here is build the case for why we should be using machine learning in finance. And I think the very best way to do that is with development of the theoretical properties of highly parameterized models. Okay, so that's all we do in this literature. And the main theoretical result that we've shown in a couple different environments now, and I'll take you through those, is that model performance, measured in a variety of ways. You can measure it in terms of statistical performance. You can measure it in terms of economic performance, say in utility terms or Sharpe ratio. Model performance of asset pricing models is generally increasing in the number of parameters that those models have. So what I'll try and do is spend a little bit of time explaining the intuition. This is a short presentation, so we aren't going to be able to go into too much detail. And I'll also show you some empirical evidence that supports the theoretical predictions. So with that said, let's get directly into the environment. I want to give you a stylized environment to begin with to get a little bit of our feet underneath us thinking about heavily parameterized models. So in the stylized environment, I want you to be thinking about a problem where we're trying to forecast a single time series of returns. So think about R here as being the return on the aggregate market portfolio. And I want you to take as given, just for a simplification to make this concrete, that we know the set of predictors. Let's call those G. So G will be a vector of predictors. Maybe they'll be sort of, the usual suspects that we like to think about in macro finance for predicting the equity risk premium. So when I think about what finance and economic theory is good at and what it's less good at, I usually think about economic theory as being pretty good in terms of giving us qualitative predictions about the way the economy behaves. So things like, oh, here is a set of variables that might be useful for understanding future return distributions. Where I think economic theory is often less clear is on the specific details of functional forms. So if I think about a predictive function, F here, that relates the current predictors to future returns, oftentimes we make a simplifying assumption that F is linear. Oftentimes our theories make predictions that F is linear, but that is really a choice on the part of the researcher, a choice on the part of the theorist for the most part. So I want to approach this prediction problem from this concrete setting where I posit that I know the existing predictors, G, but I don't know the prediction function, F. All right. This is really the foundation of thinking about machine learning. It is really just the foundation of non-parametric econometrics. We know that if we want to approximate an unknown prediction function F, an effective way to do it is with basis expansions. We have many so-called universal approximation theorems that allow us to approximate an unknown function F to an arbitrary degree of accuracy, as long as we include enough basis terms of the original arguments of that prediction function, right? So each S here, and S is going to be indexed from 1 to P, where P is the number of basis terms in my expansion, is just some nonlinear transformation of the original predictors. So I add them all up in some way with some weight vector, and I transform them through what machine learners would call an activation function, but it's just a nonlinear basis transformation, maybe a max operator, maybe a sine function, or so on. And what the basic universal approximation theorem tells us is that as I make the number of terms in this approximation large, in the limit, I'm able to recover the original unknown prediction function. Now, to combine all of these basis terms, I need to estimate some parameters, these betas here, all right? And this approximation holds in theory. I still have to estimate this approximation in practice, right? So what I've just described is, of course, the underpinnings for a neural network model. In a neural network, I begin with some fixed input predictor variables, call them G. And then what I do is I convert those G's into a bunch of basis terms. We call those neurons in a hidden layer. All right, so those neurons will correspond to my variables S that I've constructed out of my original raw G data. Once I have these G's, which are expressing the nonlinear attributes of my predictors, I'm going to recombine those basis terms in a final linear prediction step. That's the estimation of these beta coefficients, right? So the general pipeline when we're thinking about a machine learning prediction problem is that we posit some unknown prediction relationship, and then we approximate that unknown prediction relationship with a linear function that uses a nonlinear transformation of each of the predictors. All right. So the question is, how big of a model should I use? How many of these basis terms, P, should I use? Because there's a clear trade-off, right? The approximation theory says I should make P very large. If I make P very large, then I have a good approximator. My specification error gets smaller and smaller as P gets bigger and bigger. But as I add all of these terms, well, now I have more and more parameters to estimate. And we know as we estimate more and more parameters, holding the amount of data fixed, the estimation of those parameters is going to induce sampling variation, and that sampling variation can get worse with the size of the model, right? So that's the trade-off we're thinking about. And the central research question is, which P should the analyst opt for? And we're going to put forth an answer that might seem a little bit counterintuitive first, but hopefully we'll be able to understand why this happens. And the answer is that you should use the largest possible P that you can compute. Adding more coefficients, adding more nonlinear terms to your approximating model dominates the cost, the statistical cost, the variance costs of having to estimate those additional predictors. All right. So again, in the interest of time, I'm not going to be able to go through this in too much detail. But what I want us to appreciate is that when we think about the number of parameters in our data set, number of parameters in our model, we need to be thinking about this in terms of the number of observations in our data set. So I'm going to be focusing on this ratio, which we call C for complexity, which is just the number of parameters relative to the number of training observations that I have at my disposal. And traditional statistics, such as that Box-Jenkins idea that I gave you at the beginning, the Tukey principle of parsimony, is based on behaviors like those that I've shown on this plot here, which is as I increase the number of parameters of my model from a really small number to a number that starts to approach C equals 1, i.e. the number of parameters starts to approach the number of observations that I have to train on, the performance of a model in terms of out-of-sample behavior, right? So out-of-sample R squared can start to look disastrous, right? Bigger models start to do worse and worse out-of-sample as we approach C equals 1 from below. What's happening here is that as C approaches 1, I'm fitting the training data better and better. When C equals 1, in fact, I exactly fit the training data. When I have the same number of parameters as observations, I exactly fit the training data. When I do that, my beta estimates have an enormous variance. Because of that enormous variance, when I bring this model out of sample, the forecast variance is so large that the R squared becomes extremely large and negative. All right. Now, this is perfectly in line with the Box-Jenkins intuition, and it's perfectly in line with a lot of the ideas of statistics that we were trained on. But what's less obvious is why this happens when we take C above 1. When we start to use more parameters than observations, some very interesting things happen. First of all, the variance of my estimates doesn't continue to rise. It actually starts to recover. and the R squared doesn't keep getting more and more negative, it actually starts to recover and eventually becomes positive. Why does this happen? The reason why this happens is not something that we can get into in detail in the length of this presentation, but it's because when we choose a large model, we are performing a particular set of operations that allow us to improve the approximation capacity of the models that we use, but at the same time, improve that approximation with a relatively low variance. The low variance comes from a form of implicit regularization that happens inside these models. This implicit regularization is critical to the behavior of complex models, and it is, in fact, the source of the virtue of complexity. All right, now, in order to understand the idea of implicit regularization in detail, I'm going to need to refer you to the original paper that we wrote on this topic, Virtue of Complexity and Return Prediction, that we published in Journal of Finance a couple of years ago. But taking that idea as given, what this ultimately implies for the behavior of financial models is that as we increase the number of parameters in our model, the performance of those models increase in terms of their expected returns. Their volatility increases at first, but eventually recovers due to implicit regularization. And then when I look at the overall usefulness of these models in terms of Sharpe ratio, I'm really just thinking about the ratio of these two effects. The sample Sharpe ratio is improving as I add parameters. Why is this? It's because as I add parameters, the approximation of my model is getting better and better. It's getting to look more and more like the unknown true model. But the variance of the model is not exploding, and that's really the surprising effect, right? So the surprising effect is that as the number of parameters grows, approximation capacity grows. We sort of knew that would happen, but what we didn't expect would happen was that the variance would also sort of start to be controlled in this particular region of C greater than 1. All right. So the surprising benefit of these complex models is actually coming through this relatively low variance of complex models. Again, that's thanks to implicit shrinkage. All right. So the way you should think about this is that the virtue of complexity arises from a trade-off. And it's coming through the fact that approximation benefits of complexity dominate the statistical costs of having to estimate all those additional parameters. All right, so for those of you, again, that are interested in more detailed intuition on this, I'll point you to the JF paper or to a new paper that Semyon and I wrote recently called Understanding the Virtue of Complexity. All right, what I want to do now is move on to the cross-sectional setting. I want to think about asset pricing models for many assets. So if you recall the original formulation I gave you, it was about thinking in terms of predictability for a single asset in the time series. I want to move now to thinking about the joint pricing of many assets in the cross-section. All right, and
Brian, yes. if I may just, could you just explain us, is there any specific assumption that you have to make on the signals, for instance, on the covariance structure of the signals that you use, on the weakness or strong with respect to this general setting?
Sure, this is going to take us a little bit of while to get through, but let's talk about it. So the key assumption that I need here for this result is an assumption on the nature of the signals, which I'm going to describe in terms of the beta on those signals, okay? So the assumption here is that these beta coefficients are ex ante identically distributed. So what does that mean? What that means is that before I go to train a model, when I build these nonlinear features in my neural network, I can't tell you which of these nonlinear transformations is going to be more or less useful for the ultimate prediction than another. That's the assumption that I need. Now, what's interesting is that that assumption is more or less guaranteed by the structure of many of the neural networks that we look at. If you think about it, what happens inside your typical vanilla neural network is you take these original predictor variables and you start to distribute their information in an ex ante identical way across all of the nonlinear terms. I'm not sure if you guys can see this thing that's cropping up here, but So you start to distribute this information in an ex-ante identical way across all of these hidden neurons. Now, when you do that, you're, in essence, precluding yourself from being able to understand whether it's this first nonlinear transformation or the last nonlinear transformation that's more or less likely to be useful. So if ex-ante all of these predictors are identical in their additivity, then of course ex-post will be very different in their additivity. Some will be more useful than others, always ex-post. But ex-ante, that's the assumption that we need. We like this assumption because it is very closely tied to the structure of the types of neural networks that we use in practice. All right. So what that gives you is, in essence, this idea that as you increase the complexity of your model, the incremental benefit of adding each predictor doesn't start to decay, right? Now, of course, this curve is going to eventually level off because the information is being, right, kind of subsumed by many predictors as I add each subsequent predictor, but the individual contribution of any one is ex-ante identical, right? So that's where a lot of this result is coming from. Okay, so I want to move on now to talking about the cross-sectional setting. And to think about that, the important place to start is to think about the APT. So what I want to do is to recognize that when we write down asset pricing models and we write down small parsimonious specifications of asset pricing models, we are oftentimes working in essence off of Ross's conjecture. And that conjecture is that there's a small number of factors that govern the joint variation of returns. Okay, but I want us to appreciate that this is a conjecture, right? We can talk about the empirical validity of this conjecture. That's going to be important content of this paper, but it is a conjecture. And what we have from the APT is that once we have this conjecture, plus some no arbitrage arguments, then we get some pricing relationships that emerge. And we like that model because it's tractable to work with, mostly due to its parsimonious assumptions. But we could start from a different conjecture. And that's exactly what we want to do in this paper. So in the APT or AIPT setting, what we're talking about is an AIPT as beginning from essentially the other end of the spectrum that Ross started from. So we want to consider asset pricing models with potentially an exorbitant number of factors. And each of these factors, just like the nonlinear terms in a neural network, each of these factors have some ex-ante viability of being useful. All right. So this conjecture is rooted in the theory of ML and AI, the idea that complex models tend to outperform simpler models. And so we call it AIPT as a juxtaposition with AIPT, artificial intelligence pricing theory. But the premise here is that if we think about the history of sort of empirical asset pricing, we can encapsulate it in the SDF framework, right? So if I have some SDF, let's call it M, that M prices risky assets Ri with zero pricing error. So this is just a statement of the Euler equation in any SDF-based model, right? And so I can represent this SDF in tradable terms as a portfolio of the risky assets in the economy, okay? So well-established theoretical results in asset pricing tell us that this representation holds as long as there's no arbitrage in the economy. All right, the big question then is, what is this tradable portfolio? How does it look? In other words, how do I weight each of the risky assets? What does this weighting function look like? All right, so when we typically build asset pricing models, think about the Fama-French model as a starting place, we're thinking about this as a conditional weighting function. The weight we put on, say, Microsoft or Caterpillar Tractor or whatever asset we're considering is going to be a function of the observables for that asset. And we can represent the Fama-French SDF in a very simple, sparsely parameterized model, a parsimonious model, right? What that Fama-French model in essence implies is that the weight on each individual asset is dictated by the size of the asset and the value of the asset. Or if you look at the more recent incarnations of the model, it's going to look like it depends on a couple more characteristics. So what does this accomplish for us? It gives us an SDF that's extremely parsimoniously parameterized. And of course, that has some attractive features because parsimonious models are going to have coefficients that we can estimate with low variance, but it also has some detracting features. And the detracting features is that This is just a human-chosen model specification. And the correct specification for this SDF weighting function might look very, very different. And so what we want to consider in this paper is just a different specification for that weighting function. Rather than restricting W to be parsimonious, we want to blow W up. We want to include an enormous amount of conditioning information in there. And the way that we're going to do it is that we're going to make W a function of a large conditioning set in a very nonlinear way. And as you might guess, we're going to do this with a neural network. All right. So the formulation that we have in this particular model is, in essence, the analog of the formulation that I was talking you through in the earlier slides. Is I'm going to begin with conditioning variables. Think of these as stock level characteristics. They might be size, value, momentum. And then I'm going to produce a bunch of new nonlinear transformations of those characteristics that I call S. All right. So think about this first term S as taking all of the characteristics for a stock, wrapping it through some new nonlinear tweak, and just producing a new observable function of these characteristics that I have at my disposal. There are, of course, infinitely many such transformations I can make. When I build these nonlinear functions, it's as though I've just taken one data set of stock characteristics and converted it into another data set of stock characteristics using some functional transformations. Now, when I do this, what I've done is, in essence, taken the original characteristics and tried to capture a whole lot of their nonlinear attributes, their nonlinear behavior. That's what each of these numerous terms in the hidden layer of a neural network are representing. Now, once I do that, and I rewrite my SDF in terms of this approximating function for W, what I see very quickly is that I have all of these characteristics that I've built. They may be very highly numbered. They might be thousands or maybe even millions of nonlinear characteristics. I plug in my W function, and now I have these characteristics interacted with the set of risky asset returns R. And of course, this is no surprise. We see that this S prime R is a collection of what we typically refer to in the asset pricing literature as factors, right? These are just dynamic trading strategies. They are characteristic managed portfolios. All right. So what we can do then is say that any high dimensional SDF is going to have a representation as just a combination of a high dimensional set of factor returns. All right. This is a very close analog to the Fama-French model. The Fama-French SDF is just a linear combination of a handful of characteristic managed portfolios. So all we've done is expand out the specification of our SDFs so that we can include much more complicated versions of the usual conditioning characteristics than we typically use. All right, so in the interest of time, I want to show you a couple of results. First, just to give you a little bit of a clearer insight into the way that this model construction is actually processing. When I build my factors in, say, a traditional Fama-French environment, what am I doing? I'm using the characteristics as portfolio weights. So one of my characteristics might be book-to-market ratio. So I take the collection of book-to-market ratios for all stocks, I rank and center it, and then I use those as portfolio weights, and I aggregate up all the risky asset returns according to those portfolio weights. Then we call that a value factor. I do the same thing with size characteristic, with a profitability characteristic, with an investment characteristic, and so forth. And then finally, what is the SDF in a Fama-French model? It's just the mean variance efficient combination, the tangency portfolio of these 4 factors, 5 factors. All right. The complex analog of this is to say, listen, instead of just using plain old book to market, why don't I produce a new characteristic? It can depend on all of the characteristics in very complicated ways and in nonlinear ways. I can produce many such characteristics by just varying the ways that I add up all of these usual characteristics, passing them through a nonlinear activation function. And now I can have perhaps thousands or millions such characteristics. They are not using any different data than the Fama-French model. They're just using the data in a different way, a different nonlinear representation. By the time I build out the factors using all of these new characteristics. It just means that my time series of factors is going to constitute about, well, in this case, 10,000 different factors. My SDF then will be a mean variance efficient combination, the tangency portfolio of this high dimensional factor set now. All right. Now, of course, because we're using high dimensional models here, can no longer use in-sample evaluation. In-sample evaluation is going to be just mechanically scaled up in proportion to the number of parameters that I put in my model. So all of the evaluation that we're going to be looking at here is, of course, out of sample. But that goes without saying when we're doing empirical asset pricing work with machine learning. All right, so lastly, I'll just show you a couple of empirical results, and then we'll wrap up. So the data that I'm going to work with here is really a lot of usual suspect type of data. So I'll look at monthly stock returns in the US starting in 1963. The conditioning set of characteristics is going to include 130 characteristics from my paper with Theis Jensen and Lasse Pedersen in 2023. And then we're going to look at out-of-sample performance, both in terms of SDF Sharpe ratio and in terms of the SDF's ability to price a variety of test assets out of sample. Okay, so here's a very quick glance at the performance of complex SDFs as we go out of sample. So again, on the x-axis, I have C, which is the number of parameters in my model, or equivalently, the number of factors in my model. So as I increase the number of factors from a small amount, think of a 2, 3, 4 factor model, these have, depending on the amount of regularization that I use, somewhere on the order of 1 to 1.5 as the mean variance efficient portfolio Sharpe ratio. This is typically what we see in the asset pricing literature. As I add more and more nonlinear transformations, and therefore more and more nonlinear factors, what I end up with is a big increase in out-of-sample performance. Note that as I move from small c to higher and higher c, higher and higher complexity, I'm not changing the information set. I'm just changing the model specification to include more and more parameters. All right, so Sharpe ratios are increasing in parameterization. Pricing errors are decreasing in parameterization. All right, let's do a little bit of model comparison. So what I just showed you was the behavior of a complex stochastic discount factor. This is the Sharpe ratio of the complex stochastic discount factor out of sample. I want to compare that with the out of sample Sharpe ratios of some of the standard parsimonious factor pricing models out there. So we have the Fama-French 5-factor model plus momentum. It gives you about a 0.7 Sharpe out of sample. We have the Standby-Yuan mispricing model. We have the Ho-Shu-Zhang Q-theory-based model. We have Daniel et al. We have Barilas-Shankin. All of them are giving you something on the order of 0.75 to 1.25 in terms of out-of-sample Sharpe ratio. So when I say that machine learning in finance does not just improve performance in percentage terms, it's actually improving performance at a much more dramatic scale. This is what I want to emphasize. These are the types of differences that you can get, again, just from introducing nonlinearities into your specification. In panel C, I'm showing you pricing errors. So I'm looking at a couple of different models. Those are specified by the different bars. And then the different groups of bars are different test asset sets. So what if I use the original JKP factors as test assets? What if I use an enormous number of test assets that correspond to some complex representation, or even just the original Fama-French 25 size and value portfolios? What you see is that the pricing errors coming from the complex model in all of these situations are much smaller than you get from parsimonious models, right? So this is a nice kind of comparison. The Fama-French specification was originally designed to answer this question about how do you price these complicated portfolios of 25 size and value sorted assets. But even with a complex model, we can beat this parsimonious model that was sort of designed for this setting. The last thing that I want to do, this will be my very last slide, so I appreciate you bearing with me. And everything that I've shown you so far in these empirical results, I've used these 130 stock characteristics from the JKP paper. What I want to show you now is the behavior of complex models. If I literally restrict the inputs of the model to just the 4 conditioning variables in the Fama-French model. All right. So this is using, I'm sorry, 5 conditioning variables: size, value, profitability, investment, and momentum. So what I'm going to do is I'm going to look at the original Fama-French model. Then I'm going to compare that model's SDF performance to a model that uses the exact same set of characteristics, but represents that in tens of thousands of nonlinear transformations of just these 5 characteristics. And what you see is, again, this is your 0.7 Sharpe ratio for the Fama-French model plus momentum. What happens if I just take Fama-French data and convert it into a complex specification? You see that the Sharpe ratio ranges from something like 2 to 2.5, depending on the amount of shrinkage that I use in that model. Okay, so there's more in the paper thinking about the economic underpinnings of what's going on in this SDF. We don't have a lot of time to go into it here. So I'll just wrap up with a couple of brief conclusions. So the first conclusion is that asset pricing as a research field, asset management as a practitioner field are in the midst of an ML boom. We are in desperate need of theoretical insights into the properties of ML models for these types of applications. And that's what we aim to deliver in the sequence of papers. And so what we show, this is both theoretically and empirically, is somewhat contrary to conventional wisdom, perhaps to say the least, that higher complexity improves model performance pretty much across the board in terms of the analyses that we looked at. And the best way that you can think about this is that the benefits of improving the specification of models by adding parameters outweigh the costs of statistical variance, sampling variance that comes from having to train those additional parameters. An important caveat is that this is not a license to add arbitrary predictors to a model. Think of it more like the Fama-French setting that we just went through. Start with what you believe are plausibly useful predictor variables, conditioning variables. Once you have an economically plausible set of conditioners, then we recommend using those conditioners in a high-dimensional, rich, nonlinear way. That's where the benefits of complexity come from. All right, so I'll stop there. Thanks very much for giving me an extra minute or two.
Thank you very much, Brian. Great talk. So now I pass over to my colleague, Professor Ramanupal.
Thank you. Thanks, Brian. That was an excellent talk. You've also broken the record for the maximum number of participants at one of these talks. We have more than 300 people listening in. I think it's very clear that the work you present is a great departure from the way, at least in finance, we've been thinking about for the last 70 years. And so there's a lot of soul searching amongst people who believe in complexity and people who find it difficult to leave the world with which they grew up, believing that simple models must beat complex models. So, Brian, my first question to you is about the definition of a factor. So like if you look at Chamberlain and Rothschild, they define a factor as something that explains the covariation of asset returns, so something with a large eigenvalue. And so when I look at the kind of data you've looked at, I've rarely found more than 3 or 4 factors. So, even before you start doing any asset pricing, if you just do purely statistical analysis, you find that 3 or 4 factors explain 99% of the variation. So all the other factors that you are building, what exactly do they explain?
Great. This is an excellent question. So just in terms of nomenclature, right? When I talk about a factor is a characteristic managed portfolio in our environment. You raising the question about what is, in essence, an eigenvalue or an eigenvector in a covariance matrix of assets. We spend an enormous amount of time talking about this in the paper. So there's a very close mapping between what's happening in complex models and what's happening in this eigenspace, right? So when we talk about factors and we talk about complexity in terms of the number of factors, we're talking about just building many characteristics upon which we can form sorted portfolios. Now, the joint behavior of those sorted portfolios is going to be critical for understanding the behavior of a complex SDF, because that's going to really rely on the covariance structure of these Fs. So what you get out of the theory that we build in our paper is really a theory of understanding the covariance structure, the eigenvalue and eigenvector structure of a covariance in a complex environment. One thing that's really important, and you touched on this point, is the question of inference about the number of true factors in a covariance matrix. And this comes back to my original motivational point versus APT. APT is saying, well, we have a covariance matrix. It has a couple of dominant eigenvalues, and the rest are much smaller. Whereas the AIPT conjecture can be viewed as actually the distribution of eigenvalues is much more even, right? There are many, many more factors that can be thought of as having an important eigenvalue associated with them. Which is true? Well, you might say, well, why don't we just look at the empirical covariance matrix of factors? Well, you can do that if you are in a parsimonious environment, if complexity is low. If complexity is high, it actually begins to be very, very difficult to infer the true number of factors because you don't have enough data points to estimate the eigenvalue distribution accurately. In fact, random matrix theory tells us that these eigenvalues in a complex environment get all smeared out. It gets very difficult to infer anything about their structure. We have a big discussion about this in their paper. So I think that what we have in the literature is a lot of assumptions on the econometric environment that allows us to measure the true number of dominant eigenvalues. But we believe that in the environment that we're studying, actually those assumptions are violated. Right? So I would just kind of conclude with a caution about us interpreting the prior literature correctly as implying that there is clear evidence that there's a small number of common factors in the cross-section of returns. I think the evidence is much less clear about that.
So I'll say you don't need any assumptions actually, because you can just plot the eigenvalues and just do a simulation where there are no systematic risk factors, compare the two plots, and you can see that the number of latent factors is actually quite small. But
absolutely. We have this analysis in the paper. This is exactly the right way to look at it. Simulate a low-dimensional factor structure and then calculate the empirical covariance.
Yeah.
The empirical covariance structure, the eigenvalue distribution, is going to look very, very different than the true distribution. And we have a nice plot in the paper that shows whether you simulate from a small number of true factors or a very large number of true factors in a complex environment, the eigenvalue distributions are right on top of each other. And that's exactly as the Marchenko-Pasteur-Lemmer theorem would predict. So this idea that you can infer by looking at the empirical eigenvalue distribution is just not true. That's a statement that's true if you have a much more parsimonious environment than the types of environments that we're considering here.
So, Brian, my second question to you is taking advantage of your experience at AQR. So, in terms of trading strategies, what do the complex models generate, like in terms of trading volume, price impact, short positions, leverage? How easy is it to implement these policies?
Sure. It's an interesting question. So let me just say that my role in the asset management industry is to oversee a team of researchers that build machine learning-based portfolios. I think the existence of this role probably speaks to the effectiveness of these types of approaches. At the types of frequencies that we often look at in the asset pricing literature, things like monthly rebalancing, and with the types of transaction costs that we sometimes consider in the asset pricing literature, you can expect these types of analyses to deliver excess performance above simple models in a net sense. So what we see in the literature is not, so what we see in the literature in gross terms is, of course, an overstatement of what's possible, because what's happening when we trade in the academic setting is we're trading an enormous universe of assets that includes small caps and micro caps. Many of those may not be tradable. Many of them are certainly not shortable, right? And this is going to be a fairly short intensive strategy. But if we were to sort of reduce this to a set of assets that are highly tradable, in fact, I think I might have, yeah, so here is a breakdown into different size groups. So here I'm looking at SDFs. If I just look at about the top 500 stocks every period, certainly a highly liquid universe and everything in there is shortable. You can produce something that looks like a Sharpe ratio on the order of 1.5-ish, let's say, right? I think this is probably closer to something that would be reasonably implementable. But the key point is not what is the level of the Sharpe ratio. The point is that as I look across complexity, all of these models have access to the same assets, right? They have access to the same information. They have access to the same trading costs, right? But it's the high complexity models that are more effective across the board.
Thank you, Brian. Like maybe we'll give Thomas the chance, and then there are some questions in the chat.
Yeah, perfect.
Great, thank you.
Thomas?
Thank you very much. Yeah, thank you very much for this very insightful presentation on a very topical subject. I think it's very interesting for us as a students to get exposed to this kind of papers. So thank you for that. The first question on my side would be, well, you suggested that we should use the most complex model we can compute. How does this principle apply when, for example, we believe the underlying data generating process is very simple, for instance, over a very short period of time? And in practice, how do you see the trade-off between the potential accuracy gains from complexity versus the costs, which can be, computational or otherwise, of implementing such models?
Yeah, great question. Okay, so first of all, I would say that it's an assumption that the underlying data generating process is simpler at high frequencies. Okay? I've never seen any evidence of that fact. So let's leave that part aside and let's think about what are some of the costs that we face of implementing high dimensional models. Well, one is, of course, compute cost. I think that's why I was sort of talking about you should compute a large model if you can compute it, right? In reality, compute is not free. And so in practice, you can expect that asset managers are not building infinite dimensional models or nearly infinite dimensional models, right? There's going to be some interior solution that's optimal because of compute considerations. The other thing that might be a little bit more subtle are the operational complexities of using complex models. Okay, so one such operational complexity is that you need to be able to develop code bases that can be used throughout an organization. You have to be able to diagnose issues in the model sort of in real time. And then if you think about kind of interaction with investors, if you're an asset manager, you have a client base that you need to communicate with. And so questions about communicating what your model is doing to your investors is an important consideration. Now, I think all of those are addressable, but they do on the margin point towards smaller models, right? They're going to constrain ultimately the size of your model. But where you land in that cost-benefit trade-off, the benefit of using a big model is substantive enough that the costs of using high complexity models are not going to sort of offset the benefits until you're quite deep into the high dimensional spectrum, right? So you can think about asset managers that are using machine learning models as very likely having models that have at least thousands of parameters, if not many, many more. But perhaps, we don't need to worry about them yet using models, on the order of GPT.
Okay, thank you. And to just jump on your answer, did you ever apply this kind of very highly parameterized model in your position, for example, at AQR? And when, for example, you had a performance attribution to tell to clients, how did you manage it?
Yeah, right. These are good questions. You know, there are some compliance issues with giving answers. I gave a little bit of a suggestive answer to Raman's question on this topic, which is we use these models. We like these models. They are important contributors to the behavior of our trading strategies. But I can't give any kind of breakdown in terms of what their performance looks like on the practical side.
Okay, thank you. I don't
Thomas,
have
do you have another question, or we move to the
I
Q&A?
I can do the floor to the chat. I don't see if there.
Okay, so we have several questions from the chat box. There is one I pick, Raman, if you want to pick another one after me. Up to you. The first question, doesn't your your complexity ratio P under T imply that we can simply increase complexity by just decreasing the number of observations? Then you are implying that looking at just the latest available data would be better than looking at longer time series. So just the interpretation of your complexity ratio, which is a ratio of the number of parameters with respect to the number of observations.
Sure, great. So yeah, so I encourage you to take a look at the paper. What I'm showing you here are comparative statics that can be viewed as the role of changing the number of parameters, holding the number of data points fixed. Okay? So these comparative statics are very useful for that type of analysis. The theory is much more complete than that. In the theory, if you start to increase complexity by lowering the number of observations, now you have two offsetting effects, right? There are some benefits. Let's say that you are you're starting from a point where T equals P. Notice that there's a lot of destructive behavior from T equals P. That's sort of the worst case scenario when it comes to model complexity. So even if you held P fixed and shrunk T, in this very narrow region, you might actually start to improve model performance. But that's not really the point. The point is that as you shrink T, what's going to happen more generally is that all of these complexity curves, they're going to start to bend down. They're going to start to flatten out, right? Information makes models better. And that's almost always true. The only time that's not true is when you're in this sort of domain of attraction around C equals 1. Anytime you're out here, adding information by adding more observations is going to improve performance, right? So the best way to think about this is that these curves give you comparative statics for the role of P holding T fixed. If you wanted to add the role of T, you'd have vertical shifts in these curves. More T is going to shift these curves up, less T is going to shift these curves down.
Thank you.
Let me ask a follow-up question to what Thomas had asked. A lot of these models are like black boxes. So how do you deal with regulators and clients to communicate to them what you're actually doing?
Yeah, this is a great question. So, you know, when I think about the sort of the ecosystem of the asset management industry, in particular the quant asset management industry, attribution, right? So let's call this broadly attribution, communicating to people what your model's doing. Attribution is an important topic. But what I find is that attribution is actually dictated by the investor's demand on how information is presented to them. Because these are, we can call them black boxes, but they're perfectly defined. They're perfectly specified. They're completely specified. There's no question that I cannot ask of my model. Anything about my model, I can inspect to an arbitrary degree of precision, right? There's nothing stochastic about it or anything like that. So if the investor wants to know, okay, how much does this model expose me to inflation risk? Well, that's a very clear attribution that I can do, because what I can do is take the model output and project it onto inflation. Or what does my model do when there is some sort of meme media, right? Well, if meme stocks are going crazy, I can look at how my model behaves relative to that set of stocks by looking at the correspondence and my model positioning versus those stocks. Again, it always boils down to some form of projection of a complicated model onto a simpler model. So the way I think about it is that whenever you're doing asset management with machine learning, you really sort of have three models floating around. You have your full-blown machine learning model. You have your simpler model that people like to look at and interpret. And then you have a model mapping those two together, essentially accomplishing the projection of one onto the other.
Thank you, Brian. There's another
Yeah,
interesting question. According to the universal approximation theorem, two-layer neural networks create all possible combinations of nonlinear features. So do we need to look at anything else, or is that enough then?
Yeah, so this is obviously a very interesting theoretical point. It's a point that's been studied a lot in the machine learning literature. So of course, some of the earliest forms of the universal approximation theorem as they apply to neural networks came out in the 80s, and they were focused on shallow one-layer neural nets. Since then, we've seen the beneficial performance of narrower and deeper networks, right? And there's been some theoretical advancement in trying to understand the approximation benefits of depth. So one thing that I do not want you to take away from anything that I'm doing here is that I advocate using a shallow wide neural network. That is not the case. That is the tool that I used to demonstrate the benefits of complexity in the examples that I showed you. What I do believe is that high complexity models, generically speaking, are beneficial. I'm not making a specific model recommendation. In fact, in practice, I very rarely use shallow networks.
there is one question with respect to the virtue of complexity everywhere. So are there asset classes or markets where the virtue of complexity is weaker? So the question, is it asset dependent, or is it something that apply on any kind of asset classes?
Yeah, so I've not seen any qualitative difference in behaviors like this across asset classes, across different types of assets, industry, size, volatility, right? And you can sort of see this here as we look across the size spectrum. The qualitative patterns are essentially indistinguishable. If I sort of blocked out the tick marks on the vertical axis, you'd have a hard time knowing which universe we were looking at. So this is I think of this as a fairly universal pattern. Now, in the paper, Understanding the Virtue of Complexity, we talk about conditions under which these curves can change shape. So if you're interested in details about what actually gives rise to the specific shape of the curves that we see, I encourage you to take a look at that discussion. I think there's a pretty beautiful way to characterize the origins of these curves in terms of two attributes, which we call concentration and alignment. But again, that's too much of a conversation for us to have in a Q&A.
Thank you. Raman, do you want to take a last question, or are you done?
No, we all set. Thank you.
Okay, so thank you very much. So thanks a lot. Thanks, Brian, for this talk. Thanks, Raman, Thomas. This was a great session. Effectively, we had a lot of attendees and also a lot of questions, more than 15. Just before we wrap up, we will be back next week with one co-author of Brian. So Lars Pedersen will be there to talk about the greenium. So this will be another topic, and we'll examine the true greenium in different asset classes at different times. So thank you very much, and see you soon. Thank you, Brian. This was great.
Thank you so much. It was my pleasure.
Take care.
Thank you all. Merci beaucoup. Bye.